Okay, so thank you for joining me today for this Mortgage 101 presentation. I know mortgages are not always the funnest thing, but I would appreciate it if you guys would let me know when you have questions and just chime in whenever you want. Keep it casual, just a few of us in here. So, all right, we're going to cover a couple of different things in this class. What is a mortgage, types of mortgages, pre-qualification versus pre-approval, some documentation, and I have made some fun facts throughout the presentation. So you can see, if you see a little yellow fun fact, it looks like we have someone coming in the room. Hi. So if you see a yellow fun fact sign, you will know that it is one of my fun, nerdy mortgage facts. This one is mortgage is a French term that indirectly translates to death pledge. And the intention was to show that the pledge dies when the debt is fully paid. So I just thought that these are a fun way to keep it lighthearted and not as boring as it could be. So what is a mortgage? Like, what is even a mortgage? How did they originate? I'm going to start with my fun fact on this one. The first mortgage ever recorded in America was in St. Louis in 1766. That seems kind of crazy. We've come a long way from our 1766 mortgages, I'm sure. But the ultimate goal of a mortgage is for someone to use someone else's wealth to purchase a home. They then pay back that person, the investor. Oh, we've got another person coming in. All right. So hi, Vivian. We were just talking about what is a mortgage and where did they even originate from? So like I said, we've come a long way since our 1766 mortgages, where there were probably no terms or anything. They just kind of knew where the person lived and knew that they were going to pay them that debt back. So we have a lot of safeguards that we've created, especially after kind of going through the way that the market has gone in the past 20 years. We've seen a lot of adjustments to the way that investors are lending money. But overall, the majority of mortgages are going to be paid off over 30 years. This is just the most investors who invest in mortgages invest in a 30-year mortgage or a 15-year mortgage. So they're most likely going to have the lower interest rates. We do have all kinds of loan terms. We've got 10 years, 20 years, 15 years, 25 years, and of course our 30-year mortgage. And these can be fixed or adjustable mortgages. So we will kind of get into fixed versus adjustable rates in my nuts and bolts mortgage class, where we kind of go a little bit more in depth into the products and that type of thing. So interestingly enough, 75% of people use a mortgage to secure their property. I thought that was a really interesting statistic, especially with the way that our market is right now. And I also learned something last week, that cash deals actually statistically fall out more than a mortgage loan. So the next time someone tells you that conventional loans are not as good as cash, I beg to differ, especially with all the things that we package along with it. So there are going to be 5 different types of parts on a mortgage. So we've got your collateral. This is the home that the bank says, if you do not pay this mortgage, this is our collateral. This is what we will come and take back from you. The principal, you are probably used to hearing the term PITI. And what that is it's principal, interest, taxes, and insurance. You'll see this on a lot of different loan estimates. Your clients might ask about it because maybe some lenders don't really explain what this is. But your principal is going to be the main amount that you're paying towards your mortgage. That is going to be the biggest chunk out of that monthly mortgage payment, and it is going to go straight towards the balance of what you owe to pay off that collateral. The interest is the charge of buying money, right? We give you this amount of money for this charge. This is what you end up paying us over the life of the loan. And with a fixed rate mortgage, your interest never changes, so it stays the same the entire time. Next, we have our taxes and insurance, which of course is definitely a big chunk of our mortgage payment. Back in the day, they actually did not include escrows in your monthly mortgage payment. But what happened was if you default on your mortgage, the only thing that goes between a bank and their collateral is going to be a tax lien. So the reason that they started not necessarily requiring people to pay their taxes and insurance in that monthly escrow, but they definitely give an incentive. So mortgages, you can waive your escrows, but if you waive them, you're going to be about 1/4 to 1/2 point higher in interest rate than if you did not waive it and if you paid it in your monthly mortgage payment, because the investor does not want anything to happen to the property that would get in the way of them being able to take back that collateral. Make sense? Good. Does anyone have any questions so far? Awesome. Okay, so these are going to be your 2 basic rules of mortgages. So when the US dollar is weak, mortgage rates should fall. And when the US dollar is strong, mortgage rates should rise. Now, we have seen this a little bit too close to home recently because we've been through kind of a crazy time, you guys. Like, we have lived through, quite frankly, one of the craziest things that our entire, species has gone through in a very long time. So when COVID started happening and everything started coming out with this uncertainty and people were losing their jobs and we didn't really know what was going to happen. Were we going to be able to show houses? The mortgage rates shot down, right? They were like, wait a second, we want to make sure everybody's good to go. Nobody's feeling insecure about the way things are. The US dollar is strong. And so that's why they do that, because they want to go through and make people purchase houses and give them the ability to, if the economy is not doing great. So when interest rates dropped, see, back in November of 2019, interest rates were at 5%. So everybody's all talking about interest rates rising, but they're really just coming back to the places that they were at pre-COVID. So, and then of course, like I said, on the opposite side, when the US dollar is strong, mortgage rates should rise. And that is what we're seeing right now. We've got jobs, our economy is opening back up, everything is kind of getting back to normal. And so that is why we're seeing this rate increase. So I thought this was a fun fact to add in here. Our current US mortgage debt is $10 trillion. That is kind of crazy, but it's really awesome that we have such a strong system that is the backbone of our country and our economy. Anybody have any notes on that or anything they'd like to share? So I wanted to put this in here because I get a lot of questions from new agents, new clients, old clients, and they are like, what are your interest rates? And the answer to that is there are about 40 different factors that go into pricing a mortgage loan. So the credit score, the occupancy type, the location, program type, loan term, debt versus income, property type, and loan value. These are just a couple of the things that affect this, but I just want to kind of bring it to your attention that rates are not just, whatever the Fed rate is for the day does not equate to what our rate is for that specific borrower or program. So kind of on the same page of that, the lowest interest rate is not always the best rate. Does anyone know why this is? Can anyone give one example? So the best example of this is, first of all, people charging points, right? People are going to go in there and they're going to say, yeah, we can get you into a 2.5% interest rate, but it's going to charge you $15,000. And the other way that a lower interest rate is not always the best is if the mortgage insurance is higher. And I just really want to make sure that you guys keep at the forefront of your mind that mortgages are so extremely customizable. They have so many different factors that go into them. You can buy down the rate, buy up the rate, get extra cash to close. There is so much that goes into it that it's not just all, interest rate, and that's the end of the story. So kind of a segue into credit scores from interest rates. Credit scores are going to be one of the biggest determining factors on which program we're going to go into, because the down payment amounts for the programs are pretty much the same across the board. You can get into a house for 5% and under on almost every single property we have, unless you're doing an investment property. So the first thing I look at when I get an application is, where did our credit come in? And so the biggest things that impact credit, because I know you guys get a ton of credit questions, are going to relate to this chart here. So new credit, types of credit, credit history, outstanding debt. We're wanting to know, are you keeping your utilization rates below 30%? Are you paying these on time? What types of credit are they? Do you have a lot of installment loans? Installment loans are going to be weighed a lot heavier than a revolving credit card account. Same with your mortgage. So just keep that in mind whenever your clients are going to get pre-qualified. They're probably going in and not really knowing exactly what's going on, but most likely if they come back to you with an FHA product, it's probably because either their debt to income ratios are a little bit higher than the conventional limit, or their credit score is below that allowable amount. And this is going to be our average credit scores. I'm sorry, over to the right is going to be our average credit scores for these programs. Our average conventional score is 756, FHA 676, and VA is 720. And you can look over here to the left. This is going to be our credit scores that are required to go into these programs. So 620 on a conventional loan, 580 on an FHA loan, 580 on a VA loan. We actually have a program for VA that allows us to go under that amount. USDA 620 and a jumbo loan is 680. Any questions on those credit requirements? Awesome. Okay, now we're going to talk about, okay, our types of mortgages. So we have generally 5 different sectors of our mortgages. So conventional loans are going to be funded by Fannie and Freddie, and we'll get to that in a second, but they're the main investors for conventional mortgages, which means they make all the rules when it comes to conventional mortgages. So whenever we say there's been a rise in the maximum loan amount, that is coming from the Fannie and Freddie agencies. They're the ones that fund these loans. FHA mortgages, those are going to be government backed. USDA is going to be they're going to be rural backed, and VA is going to be government backed as well. So what government backed loans means, and when something is backed, that means that if the person does not pay their mortgage, the government will. So that's why the interest rates on these products are generally lower than a conventional loan, because the investor is a little bit less at risk when it comes to these because of that reason. So they're going to have your higher debt to income ratio requirements. They're not going to require as much on your income side of things as well. So just keep that in mind when it comes to those different programs. And of course, our portfolio mortgages, which is going to be basically anything that doesn't fit into one of those 4 categories. So jumbos, bank statement loans, renovation loans, down payment assistance loans, those types of things are going to be portfolioed mortgages. And that means that someone is keeping these mortgages. They're not selling them in a secondary market. They're going to hold on to them and keep them as their own. So this is our fun fact for this slide. Some US homeowners placed a winged bald eagle above their door as a symbol of freedom from mortgage payments. Did you guys know about this tradition? I had no idea. Next slide. Okay, so who in the world is Fannie and Freddie? So like I said, those are going to be our two main government organizations. These products generally support the first-time home buyers, but they do support, our secondary home purchases as well. So it's not just your first-time home buyers. Pretty much anybody who doesn't have, like I said, an FHA, VA, USDA, or a portfolio loan is going to be financed by Freddie and Fannie. And this was interesting. Only 65% of US adults are homeowners. I put this in here to inspire you because I think that is a huge number that we can still go out and capture and get into new homes. Okay, so this slide, I am yelling at you guys about the difference between a pre-qualification and a pre-approval. So can anyone tell me the difference between a pre-qualification and a pre-approval? Anybody want to step up to the plate? You're like, no, that's why I'm here, to listen to you. Okay, so a pre-approval is going to be the secondary step to the pre-qualification, right? So I'm going to get your client's application. It's going to be a short form application. I'm going to ask them who they are, where they live, and where they work. I generally, unless I get an application that has overtime, bonus pay, tip income, commissions, or self-employed, if they're not any of those things, I generally send out a pre-qualification letter and then ask them for the additional documentation. If they do fall into one of those categories, I generally ask them for a pay stub or a little bit of an explanation as to tell me a little bit more about this income. How stable is it? How long have you received this? And then we kind of go from there. And I take that information and then get the rest of the documentation I need to then submit to my underwriter and get that fully underwritten pre-approval. And that is going to be the pre-approval on the right side of the page here. It's going to include a full review of documentation. We're going to look at the assets, make sure that there's no assets that we cannot use. Some people like to just take the mattress money that they've been saving for the last 10 years and put it into their bank account a month before they go and close on a house. And unfortunately, we cannot use reserves like that. So just little things like that, little nuances. That's really why I encourage every one of my clients to go through the full pre-approval process. And if it really starts with you guys, because if you're telling them that they need to go ahead and get a pre-approval, they're coming to me with that knowledge already. And it definitely helps the process, helps them feel committed and have some skin in the game when it comes to getting that process started. So a little bit deeper, my mortgage process, I'm going to get an introduction by the agent. I'm going to do a high trust interview with that client. So I want to get them on the phone or in person if possible, or on a Zoom call. And I want to ask them what their needs are, what their ideal payment is, what their ideal cash to close is, and what are their goals. And I keep that form in my folder at all times during the process. Make sure that we're staying within those financial goals when it comes down to it, when I'm starting to get into the numbers of everything. But so after that high trust interview, I'm going to get the application from the clients. Like I said, I'm going to send a pre-qualification letter. I always send a loan scenario so that they can see the loan that they're applying for. And then I send over a documentation request, and we get that information back, submit it into underwriting. And that is where we get our initial approval, which takes me to our next in-depth overview of the rest of the process. Any questions so far? Awesome. It must be a Tuesday. Okay, so after we get our initial approval, we're going to get that interest rate locked. We do have a lock shop and home program that allows people to lock their interest rate for up to 180 days. with the volatility in the market right now, I definitely suggest looking into that if you're 90 days out. The 120, 180 day can be good for certain people. However, I definitely think the 90 day is worth taking a look into, especially if you're out there shopping around and think you're getting ready to make that decision on putting in an offer. All right, so after we get that rate lock in and we have a purchase agreement, we're going to order the appraisal. Now, appraisals can generally take anywhere from 6 to 14 days, depending on where we're at. If we're a little bit farther out from the city, it's going to be a little bit longer. If we're closer, it could be sooner. And if we put a rush on it for $125 to $150, depending on the appraiser, we can get it back in as little as 6 days. And I'm definitely recommending doing that for all of my clients right now. Just don't really have a ton of time with the way that we're having to write these contracts now. So anything we can put a fire under, I really like to encourage our clients to do that. So once we have the appraisal ordered, we're going to make sure that our initial credit decision is good to go. We get the appraisal back, our appraisal team reviews it. If it comes in with a variance, our appraisal team is going to take that. They're going to run it through something that we call a collateral underwriting system. And we are going to have an appraisal webinar. I think it's in March 10th. I will double check on that. But Derek is going to go through a little bit more of that process. But they take that appraisal, look over it, run it through the collateral underwriting system and see kind of where we're at. And from there, they're going to call me. They're going to get me on the phone. I'm going to get you on the phone and we're going to just talk over it and see what we need to do, if we need to order a second appraisal or if the variance is a good representation of value. So after we go through that process, we're going to submit that appraisal up and get that appraisal review approved. We're going to get our final approval. We're going to send out that initial CD. And then we're going to balance that with the title company, the attorney, whoever you use. And we are going to send that final CD to the borrower and the attorney. And then we're at closing. So that is really an in-depth kind of look at the way that a file runs through my system. And my fun fact is that 31% of buyers were first-time home buyers this year. So that's really exciting. And okay, so documentation. This is something that I do have a lot of my agents try to get involved with. And I want to just assure you that I will take this off of your plate so you don't have to worry with your borrowers about chasing documents or anything like that. Now, the way that things are, we get a lot of our employment income stuff validated automatically. So our clients aren't really having to provide us tax returns anymore, especially if they're W-2'd. If they're self-employed, we do need tax returns, all schedules, personal and business, if applicable. And W-2s and 1099s, those are also kind of not necessarily needed as much anymore with the way that things are being verified through our automatic income validation system. Pay stubs, if we don't have your income validated, we do need a pay stub, your last 30-day pay stub. We also have the ability to link your bank account through our application system. So we don't usually need the asset statement unless someone is not wanting to do that, which is absolutely fine. And then, of course, we need verification of identification. We need your ID. Any large deposits that are in your account, we might need a letter of explanation for that as well. And I'm going to show you guys this video on my mobile app and kind of how it works and how it has been so incredibly easy for my clients to upload documents. So they can go and calculate their mortgage payment here. And all of you have one of these apps. We just need to make sure that you're set up on the correct one. This is the part I wanted to show you where you can upload documents straight into your mortgage file from the application. So that is, sorry guys, let me get back to the presentation. So that is going to be another seamless way that we're going to be able to get your clients to upload documents. And that is a huge part of the application process. Like everything that you hear about people applying for a mortgage, it's, oh my gosh, the documents, it was so annoying, it was so stressful. We're really trying to completely cut out any and all of that stress that people are going through, which is why we're really working on our employment validation, because it's really nice to tell a client, the only thing I need from you right now is your driver's license to get you fully approved. So we're constantly working on making sure that our clients are having that very seamless one-stop shop experience. And we all know that a home is the most important asset that people are going to buy in their life. And the experience really, really matters. So I wanted to take another moment of your time and show you this from one of my partners in my other office.
Hi everyone, my name is Kirsten Robinson.
So it sounds like you guys cannot hear her.
Yeah, we can't.
Thank you for letting me know. I've got it covered.
Hi everyone, my name is Kirsten Robinson. I'm
Can
with
you
Berkshire
hear it?
Hathaway Carolina's Realty here in Charlotte, North Carolina.
Yes.
And
Yes.
Carlin is my go-to gal. She and I have been working together for about 4 years now. My clients love her. I love her. I use her and Prosperity for a couple of different reasons. She gives a great client experience. She knows her stuff. She lives and breathes mortgage, in case you haven't seen her Instagram. And my clients see it and it shines through. They always tell me how comfortable she makes them feel, how she really is catering to them, and just really is super knowledgeable about the process. And with Prosperity, I mean, I think the appraisal board alone is enough. I have had more than a time that has come in handy and really worked in mine and my clients' favor, and times that my clients have used a different lender for whatever reason, and it did not go well on the appraisal side or the loan officer side. So she's your go-to person. Give her a call. Like I said, I'm Kirsten Robinson in Charlotte, and I hear that I might be seeing a lot of you at conventions, so I look forward to meeting you in person. Bye.
So ultimately, I just want all of you guys to know that I've got your back when it comes to getting your people through the mortgage process. I wanted to make this really an introductory overview of mortgage, and my nerdier classes are coming. I do a nuts and bolts class that goes through conventional, FHA, VA, USDA in detail. And I just want to open it up to questions right now and kind of just see where you guys are at with mortgage, and you know, what questions do you guys have for me?
Carlin,
Yeah.
hi, this is Lorena.
Hi.
My question is with the app, the My Home Mortgage. If I have a client with me and they wanna, don't know about getting a mortgage, I can like send you documentation through my app, or do they have to download their own in their phones, their app, and send it through that one?
Yeah, that's a great question. So actually the mobile app connects to their online application. So they would have to have an application with me, and then they would have to have the application downloaded to their phone, and it actually connects with their phone number. So
Got it.
if they put your phone number on their application, then that is the app that they would need to use. So every client, we can share with them our branded joint app, and they can use it to upload directly into their loan application.
Yeah, because some clients are like, they are not good with digital things like apps, and they are a little like scared to use that kind of tools.
Absolutely. And I can meet with them as well, or I do have a lot of clients that mail stuff to me as well, and we can do it through mail for those people who are not technically advanced.
Right. Okay, got it. Thank you.
And we'll definitely have a marketing course where we can go through and make sure everyone is set up on all of our marketing stuff, and everybody's app has their up-to-date picture on it and all that jazz. We'll do that the next time I come in, and whenever it's safe to kind of meet in person.
Good.
I have a question. It's Renee. Hi.
Hi, Renee.
Hi. The 120-day, I forget the name you used for the lock.
Yeah, the lock, shop, and home.
Lock, shop, and home. So are there certain criteria for the buyer that they have to meet? And is that upon execution of a contract?
So no, we don't have to have a contract to lock it in for 180 days. We do take a 1-point upfront deposit, but it's a deposit. So it goes into the closing costs and credits it back to them at the end of it. And that's the only other thing about locking in for 180 days is you're not doing it for free. So
Yeah,
it can cost you, but if interest rates rise, it can definitely save you a lot of money.
and then what if the loan does not ultimately get approved? Are they refunded that amount?
That's the catch. That's the thing. I mean, I'm sure we could talk to like the upper management and get maybe an exception, but that is the way it works.
Okay, it just might be an alternative to the builders right now
Exactly.
with their small incentives of like $5,000. They won't lock in, most of them, till 40 to 60 days out. So it might be an opportunity to have them come over to you.
Yeah, and generally we might not be able to match 5,000. I mean, I've matched 5,000 before. But we could get them, maybe we pay for the deposit, maybe it's all open for negotiation. Our team is so incredibly good at listening and kind of making exceptions.
Oh, great. Thank you.
All right. Vivian, I know you have a question for me. All right. Well, I really appreciate you guys coming on here. And like I said, we are going to be having so many more of these little powwows. And I will do a nuts and bolts where we go into the real boring stuff of it. But it's really, it really is good to know. And like I said, thank you so much. I really appreciate you guys. Know that I am always a call away or a text away if you need anything at all. And I hope you enjoy the rest of your day.
Thank
Thanks,
you.
Carlin. You too.
Guys, talk soon.
Thank you.
Bye. Bye.